Hello everybody, I am Pravesh Agi. Welcome to my channel. I am a chartered accountant currently working as a visiting faculty with the Institute of Chartered Accountants of India and associated with many universities in India. In today's lecture, we are going to talk about security analysis. Now, this is your CA final course, Paper 2, Strategic Financial Management, and I am CA Pravesh Agi, professor for this lecture. Now, let's understand liquidity ratios. Now, these ratios measures the firm's ability to meet its current obligations and has sufficient liquidity to carry out its operations. Now, one of the ratio which we will be studying is called the current ratio. The formula for the current ratio is current assets divided by the current liabilities. Now, this ratio measures the firm's ability to pay the debt in short term. So that means that whether the company has sufficient liquidity so that it can pay off its debts or liabilities, short-term liabilities within the time frame. Now, basically this ratio tells you that whether the company is able to pay its suppliers, its dues or its short-term obligations in time so that it has sufficient current assets to back those liabilities. Now, a ratio, if it is less than 1, indicates that the company's liabilities are greater than its assets and that the company would be struggling to pay off its obligations. So, while measuring the liquidity, we also calculate the receivable days and the payable days. Now, receivable days are actually in terms of how much time it takes you to collect your money from your customers. So a low ratio means that it takes a company fewer days to collect its accounts receivables, and a higher number shows that company is selling its products to the customers on credit and taking a longer time to collect the money. So which may hamper basically the liquidity position of the company and its ability to pay their short-term liabilities. So now we move on to payable days. So this is in respect of how many days you take to pay to your suppliers who supply you raw material or inputs. Now the days payable is company's average payable period. So days payable outstanding tells you how long it takes company to pay its invoices from trade creditors such as suppliers. So if you have a longer payable days, that means you are struggling to pay your money to the suppliers, and then it may affect your supplies and disrupt your operations of the company. So now let's understand the interest coverage ratio. Now, interest coverage ratio is calculated by dividing the company's earning by the company's interest expense for the same period. Now here the earnings are EBIT, which is earning before interest and tax. Now the interest coverage ratio is used to determine how easily company can pay their interest expense and outstanding debt. So if such a situation that if the company is able to pay its interest in time, because it has sufficient, it's backed by sufficient profitability in terms of EBIT. So this will mean very good for the company, and company is quite liquid. So that doesn't have any problem in paying its, servicing its debt. So this ratio is a very good ratio to determine whether company is able to meet out its commitment towards the interest which it has taken to borrow on the borrowed funds. Hope you all enjoyed the lecture as much as I did presenting for you. Do add your comments as it is very encouraging and motivating. Please do like and do subscribe. Thank you.